What is yield farming? Today we're going to talk about yield farming, what it means, how to do it, and whether it's a good way to invest in the crypto space. Welcome to Crypto Made Simple, the best place to learn everything you need to know about crypto. We make crypto simple. To really understand yield farming, we first need to talk about DeFi, its purpose, and why it's been so lucrative for tech-savvy investors. Then, we'll talk about what yield farming is, how it works, and a few examples of the different types. But before we get into DeFi, let me give you a single sentence definition of what yield farming is. Yield farming is the art of trying to maximize the rate of return on investments by utilizing different DeFi protocols and looking to exploit any opportunities that come with those protocols. Even in my single sentence summary, the word DeFi is critical to yield farming. So to make sure we all have a grasp of what we're discussing today, let's quickly go over DeFi first. DeFi, or decentralized finance, is an emerging financial technology based on blockchain technology. Through DeFi, the need for centralized organizations like corporations, banks, and governments that typically control the flow and movement of money has been removed and replaced with secure, open ledger technology, or as it's most commonly known, the blockchain. But what's the point of decentralized finance and what benefit does it provide? Now, because I want to spend most of today talking about yield farming, this is only a summary of DeFi and not a complete breakdown. But essentially, the benefits to someone using a decentralized finance setup are the removal of fees typically charged by these centralized companies, and the removal of geographic and financial barriers to entry. Also, because DeFi is decentralized on thousands of devices worldwide, it is practically impossible to shut down, meaning no matter what's happening in the world, be it war, natural disasters, or government sanctions, as long as you have access to the internet, your funds are accessible and available for trading and withdrawing. So now, if you have a smartphone and can get occasional internet access, you can be part of the financial first world, no matter where you are on Earth. There is a significant change from the old centralized financial model. Additionally, unlike other payment services like Western Union and MoneyGram, a blockchain payment can arrive in minutes instead of the usual 3 to 5 working days. Plus, crypto projects don't need to worry about international bans or sanctions since they're decentralized and operate outside any single entity's control. Lastly, because your wealth is secured in a private digital wallet, unlike the money kept in your fiat bank account, the only person who can access your digital account is you. Obviously, you have to take all the necessary steps to keep your account secure, but that's a topic for another day. Back to DeFi. When working with DeFi, especially for yield farming, smart contracts will need to be used. In short, a smart contract is just a pre-agreed, self-executing contract that only executes once the pre-agreed criteria have been met. This pre-agreed code acts as a middleman between financial transfers, ensuring that no one can cheat the system. Okay, now we know our definitions. How do people use these things to get some of these amazing returns through yield farming? Here is where it starts to get a little bit complicated, but I'll try to make sure I break it down as simple as possible. First, you're going to see the abbreviation APY a lot. APY means annual percentage yield, and it's essentially a measurement comparing rates of return across various products. Second, if you remember your old economics classes, you might remember the principle of hot money. This is where wealthy individuals regularly swap their money from one bank account to another to secure the highest interest rate for their savings. Basically, this is very similar to what happens in DeFi yield farming. But instead of having accountants spend time looking for the best rates, savvy investors have started using smart contracts to automate the process. But when talking about DeFi specifically, we wouldn't call it hot money. Instead, the terminology within crypto for this fast movement of money to secure the best rates of return is known as crop rotation. Yield farming, so crop rotation. Makes sense? Anyway, you now know what DeFi and smart contracts are, but it's time we go back and address the elephant in the room. What is yield farming specifically? As we discussed previously, yield farming is a way of utilizing various strategies to increase your rates of return. Currently, traditional saving accounts offer interest rates of around 0.1%, with anything above 3% being almost unheard of these days. However, with yield farming, you can earn upwards of 100%, which is why it's getting so much attention recently. Amazing, right? But I still haven't addressed how, so let's get into it. To understand and master yield farming, you'll need to understand three concepts, because they're the cornerstones to yield farming's insane rate of returns compared to the rest of the overall market. First, we need to know what liquidity mining is. Liquidity mining is the process of supplying liquidity in exchange for rewards, which can be used later to earn additional APY. I'll give you a definition for liquidity in just a second. For example, Synthetics was one of the first companies to reward users for adding liquidity to their SETH/ETH pool on Uniswap by rewarding free SNX tokens. When providing liquidity for a pool, users also earn liquidity pool tokens, or LP tokens for short. To quickly explain, a liquidity pool is a place where a bunch of different people that own specific coins actually pool their coins together to create a liquidity pool. A single liquidity pool contains 2 tokens, and each pool creates a new market for the same pair of tokens. For example, DAI and Ethereum was a popular liquidity pool on Uniswap, one of the decentralized exchanges where these liquidity pools are created. The liquidity pool tokens given as a reward for providing liquidity to these pools are another digital asset that can be used to stake, trade, sell, or use as leverage to increase your potential APY, as we'll discuss shortly. But what is liquidity? Again, explained simply, liquidity is essentially how easily an asset can be converted into another asset like cash. For example, cash and gold are extremely liquid because you'll struggle to find a company or person that wouldn't accept these two items as forms of payments. So when we say add liquidity to a pool, essentially we're saying add money. This liquidity helps ensure the pool stays open and is always available for trading 24/7, 365 days a year. But to ensure both sides of the pool remain balanced, smart contracts have been created that buy and sell the assets from within the pool to ensure there is always the right amount available for trading. These specialized smart contracts are known as automated market makers, or AMMS. But again, how they work is a story for another day. So what is liquidity mining? Liquidity mining is giving your assets like ETH or USDC or anything else to a specific liquidity pool on an exchange. In return, you'll be given liquidity pool tokens and maybe some of the network's native tokens as a reward too. Of course, you could always give these free tokens you've just received to another pool and once again get even more free tokens, which can also be used to stake and acquire even more free tokens and repeat that process over and over. Next, we have leverage, or using borrowed money to increase the potential return of an investment. With leverage, an investor would deposit crypto as collateral to a lending platform and then begin to loan other tokens. Why? Because you're going to then leverage those new tokens by depositing them as collateral on another platform and begin borrowing from them too. Naturally, you can repeat this step on as many platforms as you want. By doing this successfully, they can increase their initial capital a few times over, which leads us to our final point. Lastly, what makes DeFi so profitable is risk, and your understanding of risk will be the difference between getting rich or getting wrecked by high-risk yield farming. Risk here means the over-collateralization of assets. The bigger the risk, the bigger the reward, but also the higher likelihood that you'll lose it all. But what exactly is over-collateralization, and what does liquidation mean? Simply put, over-collateralization is where you offer more as a deposit for a loan than is required. Typically, this is to reduce the risk for the lender, but it also incentivizes better rates for you, because if you're offering more in collateral than you're borrowing, there's less risk than a lender will lose their capital. As a result, they'll likely provide you with a better deal on their loan repayment fee, maybe even a fee-free structure if you've really over-collateralized yourself. And liquidation is when you can no longer repay your debts, and those assets you placed as a deposit are used to repay the debt. So, hopefully you can see how this is all starting to work. You can start by providing liquidity for free tokens, be it liquidity pool tokens or native token gifts. Then, these free tokens can be used to acquire even more free tokens, and you repeat the process until there are no more pools available. With any remaining assets that can't find a pool to generate free tokens, including any liquidity pool tokens you've accrued up to this point, you could start to leverage them by signing them up to crypto lending platforms. Then, after withdrawing another token to deposit and lend elsewhere, you can repeat this process again and again. This increases your initial capital without increasing your initial investment. That extra capital can be used to improve your APY, like adding it to a liquidity pool for free tokens, like we've already mentioned. To make sure you get the best deal possible, you might over-collateralize your loans. The risk here is if your loans drop below a certain pre-grade threshold, it will be liquidated. For example, maybe the value of one of your tokens have dropped to a point where it was no longer worth enough to repay a specific value. Or say you had agreed to repay all your loans within 24 hours, but then discover that one of the exchanges you need to use is offline for maintenance. I'm sure you can see many ways this can go badly, given that smart contracts can be written to any specific requirement. The worst part, it might not even be your own ignorance that causes your downfall. For example, let's say you stake on one platform without doing enough research, and this liquidity pool suddenly vanishes. In that case, you can be left to repay other loans you no longer have the digital capital for out of your own pocket. But what about other risks? Unfortunately, smart contracts are only as good as the coders who wrote them, so it's not impossible to occasionally find a promising DeFi protocol crippled by a smart contract bug. While you can always look at the code for most crypto projects, it requires a certain level of coding knowledge to make a good decision on whether that platform is secure or not. But unlike more centralized platforms like a typical bank that could be doing almost anything behind the scenes, most blockchains have publicly viewable code and transactions for you to inspect. Ultimately, this gives DeFi an additional layer of provable trust over traditional financial systems, because you can expect everything yourself. So what is yield farming and why is it so successful? To summarize, yield farming is the art of running multiple strategies simultaneously to improve your overall returns, measured in APY. Some of those strategies are techniques like liquidity mining, liquidity pool token trading, leveraging, and over-collateralization, ideally used to create some eye-watering returns. The catch? Risk. Yield farming can be a highly lucrative strategy, primarily because of the level of risk involved. If there wasn't this level of risk, the level of returns wouldn't be as good. But to answer a question I'm sure some of you are asking, should you start yield farming? Honestly, that depends on your level of financial literacy and personal risk tolerance. People often chase the highest returns, but nothing is stopping you from staying with a more conservative approach, like the adding liquidity state and simply earning free liquidity pool tokens to sell on the market later. Sometimes slow and steady does win the race. Try to remember what your crypto holdings could be worth in 10 years before you over-collateralize them today, trying to secure quick money overnight. In conclusion, yield farming is an excellent strategy that provides incredible returns if you are sure of what you're doing. But unfortunately, it typically offers a fast track to liquidation for ill-informed or unprepared investors. Thanks for watching our video. We hope you find it informative and you're leaving with a better understanding of what yield farming is, how it works, along with some of the positives and negatives of giving it a try yourself.